Starting trading the right way and mastering it can allow you to create an income generating machine for yourself, granting you time freedom, location freedom, and the ability to scale your income working from anywhere in the world. But if you're trading with no foundation or the wrong foundation, especially if you're just starting off, you can easily waste years of your life and thousands of dollars of your money that you simply don't need to waste. So that's why in this video, I'm going to be laying out the foundation that took me 7 years of full-time trading with all sorts of trial and error before now being able to make thousands of dollars in a single day trading. So whether you're trading and you have some experience or you're starting off with absolutely zero experience, I'll be showing and teaching you the boiled down version of all the most important things that I've learned, including market psychology, softwares and charting, trading math, which is one of the biggest pitfalls for beginner traders, custom tools I'm going to share with you to be able to advance your trading faster, and access to capital so you can start with a small amount of money but still be able to trade, so that by the end of this video, you're going to have a clear-cut path to mastering trading and hopefully creating that income generating machine for yourself. So if that sounds good, make sure you hit the like button on the video, subscribe to the channel if you like trading and investing. Check us out on Instagram, Discord, and TikTok. We have an amazing trading community. So in lesson 1, we're going to start off with something completely different than what you'd think. Most people, when they start trading, want to jump into technical analysis, charts, and immediately start trying to put money into the market. Whereas one of the biggest pitfalls for a trader is going to be something that has nothing to do with actually trading and all to do with your mindset. Without first rewiring your mindset, being successful in trading is going to be almost impossible. If you take human traits that will conventionally make you successful in regular life and apply that over to trading, it will almost give you the exact opposite effect and cause you to lose more money. So that's why a lot of the smartest people, the most successful people, are actually the worst traders, because they're so stubborn and so successful in regular life. They can't believe that applying that same logic to the markets will actually cause them to lose, and that's what causes them to spiral. Okay, flipping that on its head with trading, you have to rewire those conventional thoughts and think opposite to basically everything in life that you've ever learned. One of the biggest and best decisions that I made in my trading career was reading a book called Trading in the Zone, written by Mark Douglas, who is a trading psychologist. Okay, I've made several videos about this, sort of referring to this as the Bible of trading, but I promise you this can't be closer to the truth. I'm going to show you some key points here to get us started on this video, but I strongly suggest once you make it to the end of this video to get this book, take your time reading it, and see how much it's going to change your trading. And one of the first things that he talks about in this book is shifting to mental analysis and understanding how mindset plays a critical role. As he states pretty early on, he's worked with some of the best and some of the worst traders in the business and has helped some of the worst become some of the best. Some of these specific reasons that these successful traders are able to outperform others is because the best traders are able to think differently from the rest of everyone else. And this is exactly what I'm trying to harp on. Okay, these winners have attained a mindset, a set of attitudes that allow them to remain disciplined, focused, and above all, confident despite adverse conditions. And all of the concepts that I'm going to show you in this video are going to tie into this exact thing, which basically being a good loser, because you're being so stringent on your rules that instead of trying to mask emotions, you actually learn to understand why emotions in trading actually will disappear if you're trading properly. Trust me, this is going to make a lot more sense. Before we dive into full technical analysis, I want to show you sort of the bridge between psychology and the actual markets, because I think a lot of people end up looking at charts, starting trading without fully understanding what the meaning of the charts are, what's actually going on, and how this ties into human psychology, which at the end of the day, when you're trading, you're battling with a collective group of people making decisions based on all sorts of factors to try to be able to make more money than the other person. Okay, this is player versus player. When someone makes money, another person is losing money. There's a wide spectrum of distribution depending on how many people involved, how much money's involved at different points, but that's essentially what you're looking at. So when we look over at a chart here, okay, I'm using a software called TradingView. This is basically the gold standard in the trading industry as far as looking at trading data. Okay, but even though it looks like we're just looking at squiggly lines here on a chart, what we're actually looking at is the visual representation of mass human psychology. When prices are moving up, it means that more people as a whole are willing to pay more and more money. This price is increasing because people are willing to buy at higher and higher prices from one another because they feel that it is still worth getting in as the price increases, and that demand outweighing the supply causes the price to move up. Same thing in the opposite direction when we have a downtrend. Okay, there are buyers still coming in through here. As this price is trading down, less and less people are willing to hold the price at a certain level, and people that are willing to buy at lower prices are taking taking from people that are offloading this because there's too much supply and not enough demand, causing the price to move down. And there's different ways of looking at this data. Some people like to look at it in a line, but most of the time traders are going to be looking at these, which are called candlesticks. Okay, and you'll notice that there's white candles and orange candles. You can make these on TradingView by right clicking on the chart. You can make these any color you want right here. But essentially the reason this candle is white is because for this 3-minute interval, the price opened right at this level, went as low as this level, went as high as this point, and ended up closing at this level. Since this closed higher than that gives us a positive gain over this 3-minute period, which means that the candle will be white. Same concept with the orange candles, but because they're orange, it shows me that the price opened here, went as high as this point, went as low as this point, and ended up closing right here at this level, once again making the candle orange and showing us a net negative movement on this candle over that 3-minute increment. Okay, and if you've watched my videos, we use all sorts of different tools sort of understand on a deeper level what this data is showing us so that we're able to make calculated trading decisions off of this. So all of the indicators and technical analysis that I'm going to get into in lesson 3 is going to be a deeper dive into sort of digesting and understanding how to interact with the mass human psychology with the data, which is once again the representation of collective mass human psychology. So our charts are really telling us a story. If this is a bit confusing to you, wait till the end of the video. All this is going to come together and you're going to leave here a lot more in the know. So just bear with me if you're a little confused right now. It's going to make more sense. So now I want to share with you some of the biggest things that I've noticed is the difference between a successful and a non-successful trader, and some of the foundational stuff that I harp on with the team that I know I now have that basically every single not successful trader doesn't have. Mark Douglas also touches on this point that everybody is trading with the same information. The pro traders, the institutions, retail traders now have access to the same exact data. So there's no magic indicator. There's no missing piece of information that is going to make us successful. It has everything to do with how we actually apply ourselves into an infinite amount of opportunities and an infinite amount of possibilities to make money in the market with all of the data. Okay, there's millions of combinations that will make you successful. There's also millions that won't. So it's up to you to give you that foundation and to know that you're following the right process. To do that, that's where the discipline comes in, and that's why most people aren't successful. And I'm going to break down all of those things right here onto the list, and then we're going to look at an example. Okay, so out of the pro trading foundation, we first have trade selection. So being able to find patterns to be able to take trades on that fit your system rules. The second thing is trade execution. So having the discipline to be able to enter at the right level, and also knowing how to interact with your exchange to say, take a position here and set up your risk parameters to make sure that you're calculating risk on the trade so that you can protect yourself on the downside and let your winning trades really move in your direction to allow you profitability. Okay, the third thing is going to be trade management. So once you are actually in a trade, knowing where you're going to get out ahead of time, okay, whether it's for a win or for a loss, is one of the most critical things in trading that a lot of beginners simply aren't going to do. They're going to use their emotions. They're going to go all down rabbit holes saying, oh, I should have held, I should have got out here. Okay, you're going to learn in a second why that's really stupid based on the mathematical premises of trading that I'm going to show you. Okay, and then the fourth and final most important thing, especially when you're learning, is tracking your data and being able to analyze your performance. I'll never forget this term from Andrew, who's been one of the core traders on our team for the past several years. And he always says, you cannot improve what you don't measure. Okay, this doesn't only apply to trading, this applies to life in general. If you want to improve something, you need to be able to find the source of the problem. Okay, you need to know where you stand and how changes that you make are going to affect your outcome. And the only way to do that is to dial in, know your own data, and take a look at that data and make changes that have statistical backing to actually improve your performance. Okay, and because that part is so important, if any one of these things isn't being followed to a T, it's almost impossible to quantify anything. If you're doing that, you might as well kiss trading goodbye. You're never going to be able to make money consistently because this is what's going to separate the successful traders from the non-successful traders. But do it from the perspective of someone who is following the rules and isn't following the rules. I'm just showing you an example of some intricacies in trading systems that would constitute as rules. The proper trader would put his risk below the B level, would buy at this point, and then look to take profit if the price continues moving up once he sees his highlight strip here. He'll calculate his position size so that he knows he's risking, say for example, exactly $100, so that even if he is wrong, he knows the percentage of the time he's right and how much money on average he's making to then be able to know his success rate over the course of certain trades. Okay, so that trade comes down, gets him out for a full loss, so he loses $100 on this trade. So then the next trade comes. Once again, the trader sees where the price breaks out of this point, the stop loss below this B level, which is where he will sell out of the position if the position once again goes down against him, and will wait for a highlight strip to be able to take profit on this trade. Calculates the risk on the trade, once again risking $100 on the position. Okay, so now we're into the trade. Once again, waiting for either this level to be hit or a highlight strip on my RSI. Right, so right here, we get our highlight strip on our RSI, and they close out the trade for full profit. Now profiting on the win, $153, now putting them up $50 after 2 trades. Then after the trade, the trader logs all of the data, the profit and loss on the trading system, and simply moves on to the next. Let's follow that same exact process, but now from an incorrect mindset so we can see the difference between successful and not successful. So an inexperienced trader would see that this move is breaking out of this trend. They would look to enter into the market here with either a random amount of units depending on how they feel on the trade, okay, but nonetheless entering the position. Okay, so the trade starts moving down and the trade stops them out for a full loss. If they entered with the random amount, now we have no idea how much we lost on that trade. Okay, the bad trader would either look to shift strategies and say, well, that didn't work, so I got to try to add something. I got to add a new indicator to the strategy, or I got to change something so that I don't lose again. So then we come to our next trade setup. Once again, broken through this level. Say the trader takes a long position here, puts the stop loss below this level. And then just like our last example, okay, the price starts coming down. So maybe the trader decides, okay, this isn't working out, so I'm going to take the trade off the table at a small loss just so that I don't lose too much more money. Or maybe now that it's at break even, we just avoided that loss, so I'm going to take this off the table for flat and then move on to the next trade. So then maybe they're not even in the trade anymore, and then it starts moving drastically in the direction. So they say, okay, well, it's starting to move in the direction. I should at least get a little bit of something into this trade, enter in late here, where now we should be exiting the position. But this time, if we're risking $100 on this trade, now to our full take profit level based on this indecision in here or a wide variety of psychological mistakes that may seem like you're seeing if the trade is going to work out to be able to then get in, now caused you to only make 0.78 of what you were risking on the trade. So now even though they were right about the position and had the exact same idea as a successful trader, their mindset only allowed them to make $78. So now they're actually making less on their winning trades than they're risking to lose on their trades in general. So you can see the difference in mindset, and you can see how trade selection is important, right? But also the technical execution, the management of the trade, and then once again, tracking your data. By the way, I'm going to be sharing this exact template on Notion so you can start practicing what I'm going to be showing you as we proceed and get a little further into this video. Okay, if you're still here and you're enjoying, make sure you hit the like button so that we can share this with the world and hopefully have a lot more traders thinking and acting in the right ways. All right, so getting into lesson 2, we're going to be talking about all of the softwares that you need to start trading, as well as some simple technical analysis that you can use to start dominating the charts that will give you a really good foundation to start doing technical analysis in general. When it comes to softwares, you're going to need about 3 basic ones. Okay, so the first is going to be TradingView, which is where you're going to be doing all of your trading. Okay, I have a referral link if you want to join, but I do recommend every single year on Black Friday, they do 70% off the annual subscription. So don't get it now, save the link and then use it during Black Friday. And you'll be able to save a lot of money on your TradingView. They literally do it every single year, and that's when I pay for mine. So, you know, the second biggest thing I would say is going to be a trading journal. Right now I've been building in Notion, and this is the public version of a master trade log that I'm working on to be able to put my entire database of information into Notion. But I'm going to share this with you in the description below as well for completely free. And I'm going to show you how to use this in a little bit. All right. And the third thing that you're going to need is an exchange. So where you're actually going to be placing these trades. So I trade cryptocurrency. The reason I like crypto is because the markets are open 24/7. So it makes it a lot more flexible accessible for me when I'm traveling and with my sort of lifestyle. Okay, secondarily, there's not that many really complex things that are going to move the market in unexpected ways. Or with something like Forex, the market moves with all sorts of complex geopolitical news and things that are going on between monetary policies of countries, which I personally am just not smart enough and or care enough to track. So with crypto, I can follow the basic news, let the markets move on that, and then be able to trade it at any time, anywhere. And the good thing is you don't need to start with that much money as well. So you can really start with say $100 and be able to trade with say something like $10,000. And if you do that properly, you're not adding any more risk, but it's allowing you to take real size trades and not have to put that much money of your own up on the table. So we have our software, our charting platform, our trade journal, and our exchange are going to be the primary things that you're going to need. Like I said a little bit earlier, the first thing that people want to do when they first start trading is hop right onto the exchange and start placing orders. But that's actually realistically the last thing that you should be doing. Once you have the proof of concept, you understand exactly what you're doing. Okay, so forget about the exchange for now and just focus on actually learning how to do this and learning the process for yourself. So if you have all sorts of crazy stuff all over your chart and you're not finding the success in trading that you want, or if you're brand new, what I want you to do is open up a brand new chart on TradingView with nothing on it besides your candlesticks, and I'm going to show you how to start quantifying trends and how to start doing simple technical analysis to actually be able to understand the market, so that then we're adding all of the indicators to the chart after we understand the foundational layer of what we're really trying to do in the first place. So like I explained earlier, when we're looking at the chart, all we're looking at is the collective buy and sell decisions in the mass human psychology behind all of the market participants. Okay, and moreover, we're seeing areas of supply and demand, and considering these supply and demand criteria, we can use something called trend lines or trends to evaluate and guess where there could be pockets of supply and demand, which can largely put us in positions where the price is likely to reverse, in which case if we buy in an area like this and we have reason to believe that the price will turn around and create a new trend, this will allow us to get in early on the trend and say be able to risk $100 here, but if we're right, we're making 6x what we're risking, which would equal to say something like $600. And if we can find patterns in the market and indicators that can support this decision, we only have to be right a very small amount of the time to be able to still end up making money, even if we're losing 7 out of 10 total trades. Okay, but it really does come down to the system math that we're going to dive into in just a second. But I want to keep focusing a little bit more on this technical analysis in the supply and demand. So for example, if we're using our trend lines, we can oftentimes anticipate areas where the price will come down and where exactly they will end up reversing. Okay, so right now I'm on a 15-minute frequency. So each of these candles is showing us 15 minutes. So all of this price data is basically the course of 1 month. So if we zoom in, there's going to be all sorts of different opportunities in here, but I want to keep it a little zoomed out and show you just how I start to look at technical analysis as a whole. So if I look at my lowest point here, right here, this is going to give me a trend. All right, there's also a tool right here called the parallel channel that you can use, where basically if you click along that level, say that low level, click again, and then you just move your cursor up to say some of these other levels. All right, it's going to show you an exact parallel line from say a low point on a trend to some of your high points on this trend, which as you can see, as the price moved up here, then once again, moving into the future, rejected that price and then caused the price to continue trending down the other way. Okay, so say for example, if we had this point here, this point here, this point here, I can go along this top piece of price action, starting from here, and then click down to this lowest point right here. Okay, and there's a ton of other indicators that I use to be able to make sure that we're not going to be missing this constantly, but I'm trying to explain to you how to evaluate trends. I can also notice inside of this overall trend, we have this low and this low tested here once again, where the price broke down through this, came up to test the underside of this before capitulating down. Okay, so this is another trend that was broken. So now we have a fair amount of conviction that wherever this price ends up touching this lower point, because of this previous pocket of supply, and then demand pocket here, we could expect to have another demand pocket here, anticipating the demand outweighing the supply, and then potentially anticipating a reversal here. And once again, this is hindsight. We looked at the chart already. I don't want anyone being like, yeah, you looked at the chart already. This is how we're trading. I'm just showing you that it does work. Okay, so now the price took a little bit longer to get down. So now we can anticipate this level being our low. Okay, so now price is at the low point of this trend right there. We're starting to get some level of support. All right, and if you see, if I went off of that exact high over there, and then back down. Generally in this vicinity is where we got the price to take a significant flip before getting our move up. And we can draw these trend breaks and start to see the beginning of ends of different trends all over our chart. Once again, we have this trend break here, then we have our new low established, a downtrend right here, a downtrend right here along these lows, which you can see the price rejected off momentarily before breaking through that trend. If we also look at this trend, after this level was tested a bunch of times and then was broken out through, the price came down and retested the opposite side of what's called resistance, where basically say the price is moving up and there's a level where the price can't seem to break through. That's called resistance. And then the same thing with support. If the price is trending down and it runs into a level that the price is having trouble breaking down through, that's something called support. And this is one of the biggest things to understand with supply and demand trading and just trading trends in general, excluding all of the indicators and all of the other technical analysis. When you have enough force to break through this trend line, that doesn't mean that this wall of buyers and sellers has all of a sudden disappeared. It just means that the price is strong enough to break it. And almost all the time, when we have a retest on the opposite time, this is something I coined as an overside or underside retest. This is oftentimes a really, really good point to then look to buy into, because the chances are this level is going to be a new big area of support before the price ends up pushing up and making new highs. We can see examples of this all over the chart. So notice right here, we have this high, price breaks up over this trend, comes back down to retest this area, and then ends up making a significant move higher. If we look at this trend along this low and this low, price tests the trend more and more closely together, breaks down through it, comes up, tests the opposite side of this trend before having a new trend breakdown. All right, so you can see by reading supply and demand and not having all sorts of cluttered indicators all over your chart, you can get an idea of where you want to be entering and exiting the market, and then using tasteful indicators like something like an RSI or other things that I use that I'm not going to get into in this video. You can watch more about them in videos that I'll link in a card right here. Get into a little bit more of the mud of the exact indicators that I use. But you can start to see how professional traders are really reading price action, trend analysis, and supply and demand, and using tasteful indicators in rule-based systems to be able to enter the market. So let's do a trade example here, incorporating the next thing that I want to talk about. It's going to be all about position sizing and trading math, which is one of the most important components of this game. Okay, the patterns are great, the entries are great, being able to read trends, but you have to know how to position yourself in the market to quantify risk and make sure that you're keeping things uniform, so then you can go ahead and journal them and make your trading better. All right, so let's learn what we've used so far. So we can draw our lower trend line here, which is matching up nicely to our high points right here. All right, but say we wanted to take a trade on this trend in here. Now we have price making contact right here, then breaking out of this level, touching here, then continuing on its way. So now notice we have an overall uptrend here, break of a downtrend here with new price action trending up, similar to what we saw here on a larger scale with the price now starting to trend up. So if I drop into a lower time frame, say something like a 15-minute frequency, you can now see a trend establishing here with a rejection off of that high, click down to our low point here. So now notice price is coming down, hasn't had much movement to the upside, and is coming right into our potential support zone. So this is an area where we'd want to potentially to buy into this cryptocurrency, make sure we set our risk so that then we'd be able to take a profit if this is to flip in the opposite direction. And as far as trading math is concerned, there's two main metrics that you need to be calculating in order to see if you're successful, which is your average risk reward and your winning percentage. So how many times you're right versus wrong. And when you are right about a trade, how much money are you making versus how much you're risking when you lose. So the way we're calculating winning percentage is seeing how many trades obviously we win. That's going to play into our trade journal here in just a second. But as far as average risk reward, in pro trading, we're using something called risk factors. So whether you're using $10 as the risk on your trade, or you're using $1,000 as risk on the trade, both of these, whatever your risk, if you are wrong and have to close the trade out for a contained loss, is going to be 1 unit of risk. Okay. So say in the example here, if the price does move up and get us to this area right here, we can see if we hover over our position position calculator, that would mean we made 3.55x what we were risking on the trade, which would mean that we would have 3.55 risk factors. Okay, so if we took one loss and one win, we would lose one risk factor and we would gain 3.55, which would leave us at a net positive of plus 2.55 risk factors times however much we're risking on the trade would be equal to our profit. So that's it. That's trading math. If you can figure out when you're winning and how many risk factors you're averaging on your trade, you'll be able to know exactly whether or not your system is actually working. But the only way to do that properly is by properly calculating this unit of risk here. I can already tell you a ton of traders don't even do in the first place. So we actually have an indicator that goes right on your chart that will allow you to do this as well, but I want to explain to you how the math actually works. So in order to create this 1 unit of risk right here, we need to be able to know how much money we'll lose if the price is to enter us here and then obviously exit us here. So what we're going to do mathematically is we're going to take the entry level right here, which is 8.09, and subtract that by our stop loss value, which is 7.97. Then we're going to take the dollar amount we want to risk on our position. Say for example here, it's $100, and we're going to take $100 and divide it by the difference between the entry and the stop loss to give us the total amount of units to buy at this price in order to risk the exact amount here. All right, so entry minus stop loss equals this, 0.138. Take $100, divide by 0.138 will give us 724.6 units that we have to purchase at this level. So once again, if we do purchase that many units at this level and the price ends up moving against us, we're going to have this many units traveling that distance, which is going to give us a negative $100, which is going to give us exactly 1 risk factor. Now, I like to do this math when I'm trading just on a calculator because I find it easy and faster. Now, we actually have indicators in the resource sheet below the video here called the Innovatrade position size calculator. You can just click on that and add it to your favorites, and you'll see there'll be a little prompt here that says entry price. So all you have to do is hover your mouse over here, click on the exact level you want to enter, put your take profit level, and then click on your exact stop loss level, input the dollar amount risk that you want, hit apply. And over here, it's going to show you the exact quantity that you need to buy, your entry, take profit, stop loss, and your expected profit and your exact risk reward on the trade. Now I clicked on slightly different levels, so you have a little bit of a difference in the units here, but overall, this is going to do it a lot faster for you. Put it right on chart. You'll be able to manage these in real time, and it will update it depending on where you move it. Okay, so say price comes down, we buy 732 at that level. Now we know based off of our stop loss how much money we're actually risking. All right, and you can see the price is going to chop around when we're in profitable trades, but we know we have a uniform amount of risk so that even if we are wrong about the trade, it's predetermined. And you can see price comes up, gets through the take profit level, and just as expected, when the price reached that specific point, we locked in the $368, which is just around $10 off of our expected profit. Okay, so this allowed us to lock in positive 3.68 risk factors. And so with something like a 3-to-1 risk factor, all you need to do is be right 30% of the time, meaning that you can lose 7 out of 10 trades and still wind up being profitable. Here's a table that I designed that I'll share with you in the description of the video, as well as a cheat sheet to some of our systems and other resources, okay, to show you based on your winning percentage and your average risk reward, whether or not you'll be break even, profitable, or not profitable. When we're young kids, we're wired to think when we are wrong or lose money, it's behavior that needs to be corrected. Whereas in trading, you actually need to go into trades knowing that whatever your winning percentage probability that you will lose the trade in order to open up the opportunity for this to flip and be able to get you out for the positive amount of risk factors, which say in this example, you had 3.68 risk factors times 3 wins would equal to 11 total risk factors. And say you lost, once again, 70% of the time. So 1 risk factor times 7 trades would equal negative 7 risk factors, which would net you out positive 4 risk factors times however much you're risking on your trade, which would equal to $400 in profit over, say, for example, 10 trades. Once again, being wrong 70% of the time. So the reason why we're tracking all of this data is to figure out those 2 metrics, average winning percentage and your risk reward, so that then we can see how many risk factors you'll make over 10, 100 trades. And that's how you end up turning profitable. And that's why being emotional about trades is actually really dumb once you realize it's really about just following all of the procedures, sticking to the system as closely as possible to let what you already know to be true mathematically come to fruition. That's why when people say to me, oh, you trade, you must have nerves of steel. I'm like, not really, I just understand math. And that's a weird paradox that, like I said, 99% of people are just not quite mentally designed to understand. And obviously the systems, as you learn more, get a little bit more complicated, but this is exactly what we're harping on with our private team. This is the concepts that all of these team members are focusing on in order to knock down trades and start working towards this consistency. Once again, the charts can look a little bit complicated, but once you get to that next level, it all starts making sense with the foundational layer of the general technical analysis. Shout out Danny V for the nice ARB win. All right, this is where I want to get into lesson 4, where we talk about access to capital. So on this position we just went over, we were once again risking $100. But in order to risk $100, you can see right here, we needed around 730 units, which at our entry point of $8.10 would give us around like $5,929 capital requirement in order for us to take this trade. So if you weren't using leverage, you would need to have $6,000 in your account just to put a trade on to risk $100. This is where the exchange comes in handy. So the partnerships we have are in the description of the video. Okay, you can use different exchanges. Make sure you read the terms of services before you use exchanges. For the case of Adam, once again, say I was entering at $8.10 with my 730 units. Once again, that capital requirement would be that $5,900. Same amount of dollar risk, same amount of expected profit. And the good thing is we can use something called leverage. You can see if we increase this to something like 50 leverage and hit confirm, now we have the same exact position, but now the capital requirement on that trade is only $125. Okay, even if we move this down to something like, say, 10x leverage, now we can put on $100 risk, and the capital requirement for that trade is now once again only $600, essentially dividing the capital requirement by 10. Okay, so this is going to allow you to get your proof of concept, but not have to use a tremendous amount of idle cash sitting in your account to be able to take trades with, say, $25, $50, $100 risk. Okay, and this is why I like to use leverage when I'm taking trades, because if I'm risking a couple $1,000s on a trade, I don't want to have $60,000, $70,000 worth of capital just sitting in my account. Okay, I'd rather put that to good use elsewhere, follow the system, and then use that comfortable amount of leverage to be able to still take these trades. All right, so let's get into lesson 5, which is journaling and practicing your trading. So once you have your system, you understand the analysis, and you understand all of these elements, your trade journal is going to be where all of that information, including your winning percentage, average risk reward, average risk factor, and total amount of profit is going to all be calculated, along with a ton of other details for you to be able to look at all of your losing trades, all of your winning trades. And what I've done here, I've set up a few filters. So in our inputs, we put our date, the day that we've taken it, the coin or pair we've traded, the system type you traded, time frame, whether it was long or short. Okay, some other metrics that I use in different trading systems, the risk percentage, whether it was a win or a loss, and then the P&L. Okay, you can put fees in here, and you can put other notes here. I have a confidence meter, duration, and then a slot for pre and post trade notes, so you can keep track of where your psychology was at that moment. This is once again just an example that I share with the public. Okay, so you can filter over here if you just wanted to look at one type of system. Okay, these are all one, but you can filter by that type of system. If you want to look at only all of your losses, okay, if there was a loss example in here, now it would filter all of your losses. If you wanted to look at all of your wins, you could just click that and it would show you all of your wins, right? So if you are taking a new trade, you can pop one of these, hit the open tab, and fill this information out as you go, as well as hitting trade input right here, and then clicking on adding an image and adding your screenshot, so that then you can look at all of the losing trades, look at the similarities, look at the data behind it, and try to optimize that over time. Once again, you can't improve what you don't measure. That's an exact way to measure. Once again, going to be shared with you in the description of the video so that you can get started. You can make a copy, you can make changes to it, whatever. Once you have your system down, instead of waiting for the market to develop and wasting time trying it in real life, you can use a feature to practice and track your edge and make sure that you're going to be successful by using a feature called bar replay. Okay, what this is going to allow you to do is, say we go back in time with Adam to a point where we don't even remember what happened. I'm not even looking at the chart. Okay, and you can click at that point, and then you can use this menu here to play the candles forward, and then be able to decide without remembering what happened in real time where you would end up taking trades. Okay, you can redo some of your analysis in real time and see how it comes to fruition. and then practice inputting those trades into a test. Say do a bar replay test for say 2 weeks of time, lock in for 3 hours, 4 hours, and see what your result would be so that you have the confidence that moving forward into the markets, you can trade that into the future with a solid understanding of where your mindset's at, how you're selecting your trades, how you're doing with your technical execution, how you're managing the trades, and also how you're tracking and analyzing and improving your own performance. So obviously this isn't an easy feat. This is something that is mastered over years and years, but I wanted to give you guys a solid foundation to cut out a lot of the crap and a lot of the confusion, to just give you this simple base layer to be able to build up your trading system and build that wealth generating machine for yourself. And once again, a lot of our private team members came into trading without any experience, and now they're shredding more advanced concepts. So you can see this team member right here back tested and forward tested and entered one of their first trades here for a full win, just having an awesome time with the community, helping them towards their trading goals. Once again, one of our members absolutely crushing it with 30 wins in a row with 1 loss. TDK with a full profit win in 27 minutes. GLO 4 wins, 0 losses. So we have tons of free resources for you guys to check out in the public side of our Discord, okay, including all of the tools and resources that I just described to you in this video are going to be right in this link. So you can start adding them to your trading view. All the spreadsheets trackers are going to be here, as well as all of the exchange information to get started. Okay, there's a chat to be able to chat with other traders. You can check out the daily analysis ideas that we do. And overall, just get involved, take it slow, and take advantage of the resources in the community. If you're still here, make sure you hit the like button on the video, subscribe to the channel if you like trading and investing. Let me know in the comments which part of the video was the most impactful to you. If you made it to this point, I just want to say thank you very much for supporting me and seeing the value. These videos take some planning, but I want to make the trading world a better place one step at a time. So until the next one, I will see you all in the next video.